Let me introduce myself. My name is Lance Hulbert. I'm a CPA with Huddleston Tax CPA. And we offer the small business webcast, and the next webcast will be on March 2nd on LLCs and S-Corps Explained. Then there'll be another one on March 8th for tax savings for construction, architecture, and engineering firms. March 10th for tax tips for dentists, and March 16th for tax tips for the self-employed. So you can log on to that website if you have need more information. So today the topic is tax update, the Tax Relief, Unemployment, Insurance Reauthorization, and Job Creation Act of 2010. This past December, Congress authorized a comprehensive set of income tax, estate tax, and employment insurance provisions. This was approved by the Senate on December 15th, approved by the House on December 16th, and then signed into law on December 17th. So it was a very quick process once they decided on the text of the bill. This legislation basically keeps intact for 2 more years America's existing tax rate structure. It also temporarily fixes the alternative minimum tax, and it also extends a number of deductions and tax credits and provides a temporary 1-year reduction of Social Security taxes. It temporarily reforms estate and gift taxes, and it also provides a number of incentives for businesses to invest in equipment. But the theme running through this Tax Relief Act is that it is temporary, because everything in it will expire. Most of its provisions are temporary 2-year fixes that impact only 2011 and 2012. So what this means is that the Bush-era tax cuts that were scheduled to expire at the end of 2010 will now expire at the end of 2012. From a tax planning perspective, this gives taxpayers and their accountants an additional 2 years of certainty for constructing their tax strategies. With 2012 being an election year and a presidential election year at that, future Congresses and our next president will need to address our tax system comprehensively, since all of the tax breaks that were implemented under the Bush administrations and the Obama administrations will expire at the end of 2012. So let's look at the income tax provisions. The personal income tax rates for the 2011 and 2012 years will keep their existing 6-rate structure, which ranges from 10 to 35%. If the Tax Relief Act had not passed, the tax rates would have reverted to their pre-2001 levels, ranging from 15% to 39.6%. And combined with the payroll tax cut, which I will discuss later, this extension of the individual tax cuts will provide many individuals with a significant increase in the dollars available to them. And that's happening like this year in 2011. An example is an individual, say, earning $50,000 this year, will see a tax savings of approximately almost $1,900 in combined income tax and payroll tax rate reductions. And also, this is important for individuals who converted a traditional IRA to a Roth IRA last year in 2010. They have the option to recognize 100% of the conversion as income in 2010, or to recognize 50% in 2011 and 50% in 2012. So they should consider deferring recognition of that income from the conversion into 2011